The cash ISA debate, a controversial move? In a bold move, MPs have warned Chancellor Rachel Reeves that reducing the annual cash ISA allowance may not boost the stock market as intended. This proposal, which has sparked speculation and controversy, could have unintended consequences. Currently, adults can invest up to £20,000 annually in tax-free ISAs, with the freedom to allocate this money between cash savings and stock market investments. However, the majority of savers, a staggering 66% in the 2023-24 tax year, opted for cash savings. This raises the question, will limiting cash ISA allowances really encourage a shift towards stock market investments? The impact on savers and homebuyers. The Commons Treasury Committee, in a report based on expert testimonies, strongly advises against cutting the cash ISA allowance. They argue that such a move is unlikely to prompt savers to venture into the stock market. Instead, they emphasize the need for improved financial education to empower individuals to make informed choices about their savings. Martin Lewis, founder of Money Saving Expert, was quoted in the report, stating, "The idea that preventing people from saving in cash will automatically lead them to invest in stocks and shares is simply false. Achieving this requires a cultural shift." Building Society executives also voiced their concerns, warning that reducing the cash ISA allowance could negatively impact homebuyers. They explained that building societies heavily rely on savings deposits to fund mortgages, and without these inflows, the market would become less competitive, potentially leading to higher mortgage rates. Meg Hillier, the committee's chair, echoed these sentiments, stating, "While we support the Chancellor's ambition to help savers earn better returns through informed financial decisions, we are not there yet." She added, "Now is not the time to cut the cash ISA limit. The focus should be on providing people with the necessary tools and knowledge to make confident investment decisions." Without better financial education, the Chancellor's efforts to transform the UK's investment culture may fall short, potentially harming savers and mortgage borrowers. A budget of speculation and tough decisions. As the anticipation for the upcoming budget on November 26 builds, speculation about its contents is rampant. The possible reduction of cash ISA limits is just one of the measures reportedly under consideration. Other potential changes include alterations to the tax treatment of limited liability partnerships, adjustments to stamp duty and inheritance tax, and a controversial rise in income tax, which would break a manifesto pledge. The financial landscape leading up to the November statement suggests that Reeves will face challenging decisions to balance the books. A recent downgrade in economic productivity estimates by the Office for Budget Responsibility is expected to cost the Chancellor an estimated £20 billion annually, adding to the complexity of the situation. A thought-provoking question for our readers. Do you think reducing cash ISA allowances is the right strategy to encourage stock market investments? Or is there a risk of unintended consequences for savers and homebuyers? Share your thoughts in the comments below.